Hi everyone, welcome to the Real Estate Tax Tips channel. My name is Cherry Chen. I'm a chartered professional accountant located in Ontario, Canada. My goal is to become the Google map for hardworking Canadians seeking financial freedom. And today's topic is about buying cottages. Well, because of the pandemic, we got a lot of clients calling us asking us how do they purchase cottages because investors, real estate investors, just like everyone else, they want to get out of the city. They want to sometimes move out of the city altogether, living in their cottage permanently. Some of our real estate investor clients are considering buying cottage, use it for themselves, and sometimes rent it out so then they don't have to pay extra to own that piece of real estate. Some people just purely purchasing cottages for the sake of investment, for the investment opportunity. And we got so many questions being asked to our team how it is best to structure their cottage purchase, what are the tax implications, what's the tax implication specifically on short-term rental if they were to rent it out short-term on a short-term basis, what's the tax implication if they are going to use the cottage on for themselves. So today we're going to dive deeper into the discussion of how you would be able to own cottages. Every week, I send out an email about money saving tips and real estate tax tips, all designed to help you build your long-term wealth and live life on your terms. The email takes 5 minutes to read and over 10,000 Canadians get it. Think you'll like it. Sign up using the link below. Okay, let's get started. The first thing that we're going to touch on is structure. There are 3 ways to own a cottage. The first thing is corporation. You can own a corporation that owns the cottage. The second way of owning your cottage is in your personal name. You can own it personally. And the third way of owning your cottage is via a family trust, which gets more complicated. Now, I have come up with about 7 questions to help you decide how you would want to own your cottage. The first thing is, how do you fund your down payment? It matters because some of us are real estate investors, some of us are small business owners. If you are funding the down payment of your cottage with the use of your business funds in the corporation, it matters because that may help you decide to favor to own your cottage in the corporation. It depends. There are 6 other questions that we have to look at as well. The second questions that we have is, who are you owning this particular cottage with? I have a client who was intending to buy a cottage, which was a tear down. He intended to buy it with his business partner, joint venture partner, and they intend to bring it up and they intend to rent it out short term. They intend to tear the old cottage down and build a brand new one, make a bunch of money off it, as well as owning it together and splitting the ownership and responsibility. So in that case, it may not be a good idea to own it in your personal name. Third question. Are you planning to use it personally all the time? If you're planning to use it personally all the time, it makes sense. It makes a lot more sense to own it personally because in that case, there is no shareholder benefit situation that you would have to report personally. Fourth question, are you planning to rent it out? If you're planning to rent it out, what type of rental are you thinking of doing? If you're planning to rent it out the entire winter, as in my friend's situation, she owns this cottage up north in Muskoka, and as it turns out, the town that she owns this particular cottage at is super popular for winter sports. So people would come from the States and from all over the country to that particular location, and they would do snowmobile. They would do a lot of different type of winter sports, and therefore it's really easy for her to rent it out for the cottage for the winter months for a number of months. Now, the tax implication on whether you're doing it long-term rental or short-term rental would drive the decision whether you should own your cottage in your personal name or corporation's name. Now, the fifth criteria is, how often are you planning to rent it out? If you're planning to rent it out all the time, then it may make more sense to set it up in the corporation. If you're renting it out you're not renting it out all the time, it may make more sense to keep it in your personal name. Will you be retiring at your cottage and use it as your primary residence in the future? If your plan is to retire at your cottage in the future, totally doesn't make sense to own it in the corporation. If your plan is to use it as your primary residence in the near future, or actually buying this cottage as your primary residence, definitely do not own it in the corporation. The seventh criteria: are you planning to leave it to your children? Sometimes it may your long-term goal is to have this family cottage to be enjoyed by your future generation, not just your immediate family, but also the next generation and the generation after. If that's the case, it may make sense to set up a family trust and own it for the benefit of your children. So these are the 7 decision factors that you should consider before deciding whether you should own your cottage in your personal name, corporation, or a family trust. Okay, now that we cover the decision factors in terms of deciding how you want to own your cottage, we can go in depth in terms of the benefit and disadvantage of owning them in each of the structure. The first one is personal. If you were to own your cottage personally, the biggest benefit is that typically the bank offer really good financing term for your second home. Most banks offer these favorable second home financing programs if you were to purchase your second home. So you probably get the best rate in your personal name, easiest to get financing. And there's no complicated tax situation because if you use your property for your personal all the time, you use your cottage personally for your own benefit. If you were to own that property in the corporation, it may impose something called shareholder benefit, and then you have to be taxed on your own personal use of your own property that's included in the corporation. So that's kind of silly. But because you own it in your personal name, there is no such problem. You can also use the cottage as your primary residence easily. There is no significant tax implication as long as you don't claim capital cost allowance on the property. So having that cottage in your personal name for people who own and use your cottage personally all the time is very beneficial. Now, what are the downside of having this in personal name? Well, the downside is that if you were to rent it out as seasonal rental income that you get, and capital gain on sale is all reported in personal name. So if you are already making huge amounts of income when you sell, you may trigger income tax or capital gain tax as much as 53.5%. So it could be substantial. And one downside is that the mortgage is being tied to your personal credit report. For serious real estate investors out there, it may make a difference when you are trying to avoid having so many mortgages tied to your personal credit report. Versus if you were to own the cottage in the corporation's name, you might be able to have the mortgage not tied directly to your personal credit report, which may help with future financing as well. Larger debt amount is registered with your personal name, which will affect future borrowing capacity. And if your initial down payment come from your personal name, it would be different from the down payment come from your corporation. Like I mentioned before, if the down payment that you get to purchase this particular cottage came from your small business, which you held in the corporation, you would have to withdraw the amount from your corporation, small business corporation, pay personal income tax, and then use the residual money to purchase your cottage. If you were to own this cottage in your corporation's name, on the other hand, then it makes sense there is no extra personal income tax that you would have to pay, and therefore it would be more beneficial. So it goes back to where your down payment comes in from. And it will trigger capital gain tax on death or sale of the property. So if you are planning to leave your cottage to the next generation when you pass away, or if the second surviving spouse pass away, it will eventually trigger the capital gain tax. And when the capital gain tax is triggered, your next generation who inherits the property would have to pay capital gain tax on the deemed disposition of your property upon death. So it gets complicated. That's the downside of owning the property in your personal name. Now, if you're using your cottage personally, you may also want to consider having a family trust set up to own your cottage. The family trust is being set up. You can have the family trust own it personally, and and the beneficiary of the family trust will then eventually own the cottage. So the benefit of having this family trust is that it allows you to pass your cottage to your kids without triggering any capital gain tax treatment. And you want ultimate liability protection if you ever get into any trouble with anyone doing businesses or owning your real estate portfolio. If you get sued, because the cottage is owned directly by the family trust, the cottage would not be affected. And if you were to go bankrupt, having the family trust owning your cottage will not be subject to the same bankruptcy process. So it provides ultimate liability protection. And the last criteria to set up the family trust is that as long as you don't mind paying for extra filing costs and setup fees in exchange for the flexibility that you have. The reason why I say that is because when you set up family trust, there is that family trust, the cost to set it up with the lawyer, the cost to have the accountant set it up for you, as well as the annual filing cost, because there is an annual filing required by CLA, and there is annual update that you have to do with the lawyer at the lawyer's office to update the family trust information. And at the end of the 21 years, the family trust can only last for 21 years without triggering any tax implication. At the end of the 21 years, the family trust either can pay capital gain tax on the fair market value of the cottage, or it could potentially distribute the cottage to the beneficiaries. So then the beneficiaries would be the one that are owning the cottage at the end. But there is a deadline to do it. And so unfortunately, with the family trust in Canada, you would have to comply with that rule. And so there is a deadline for you. The flexibility is only available for 21 years. Now, if you are, on the other hand, if you're using your cottage primarily for short-term rental all the time, and you could potentially consider owning your cottage through corporation. Now, the benefit of owning the property or the cottage through the corporation is that the seasonal rental income and capital gain on sale can be reported in the corporation, and there are more flexibilities in terms of tax planning. And if your initial down payment, like I mentioned a few times earlier, is coming from your existing business profit within the corporation, earned within the corporation, it makes it a lot more tax attractive and tax efficient to purchase your cottage in the corporation. The mortgage is also linked to the corporation. Personal guarantee is still required, but it may or may not affect your future borrowing capacity. If you have a goal to buy a few more investment properties, and cottage is just one of them, one way to achieve it, you may be, by buying it in the corporation, the mortgage is linked to your corporation credit report, not your personal credit report. You're still required to put the personal guarantee. It may or may not affect your future borrowing ability. Now, legal liability protection, corporation is a separate legal entity, as we all know, so it provides another layer of legal liability protection especially for those people who are operating seasonal rental, short-term rental. The downside of having the cottage owned in the corporation is that it is more challenging to get financing directly inside the corporation's name. It will still trigger capital gain tax on death on sale of the property. So except this time it is not directly on the capital gain of the property, but rather it is on the sale of shares. If you are using the cottage personally, it will also trigger shareholder benefits unless you pay for fair market value rents to the corporation for the use of your own cottage. Well, if you are planning to move into the corporation, it can still trigger capital gain tax. If you decide to move the cottage out of the corporation and sell it to your own self, it will then trigger capital gain tax or other complicated tax situation. So make sure you consult with someone who understands your particular situation, your business, and your investment objective, so that they can help you, advise you on the best approach on owning your cottage. Now that we cover the structure of how cottage can be owned, now we can move on to talk about the tax implication of owning the cottage. That's including capital gain as well as reporting the rental income and expenses. So first thing first, if you are planning to buy the cottage and you'll never rent it out, you don't have any rental tax implication, the only tax implication that you might have is when you sell the cottage. When you sell your cottage to a third party, hopefully the property appreciated, the cottage value appreciated a ton, and you would then be dinged on capital gain tax. There is opportunity for you to assign your primary residence exemption or principal residence exemption to your cottage, so then you don't have to pay capital gain tax on your cottage. However, that's only available if you own the cottage in your personal name. And when you assign a particular year to your cottage as your primary residence, then that also means that you are giving up the primary residence exemption on the other property. Let's say you have two properties. You have your own primary residence in Toronto, and then you own a cottage in Muskoka. And the moment that you decide that in 2022 you purchase this cottage, and in 2022 you decide to assign the primary residence exemption to your cottage instead of your Toronto primary residence, then that means your Toronto primary residence, the year that you are assigning the primary residence exemption to a different property, you have to pay capital gain tax on the other property. So at any given year, you can only assign your household, can only assign one property as your primary residence. You can assign Toronto house as your primary residence. You can assign the other year the cottage as your primary residence. But the key here is that at any given year, you can only have one property assigned as your primary residence. What it means is that there are ways to reduce your capital gain tax by simply assigning the primary residence exemption to your cottage, but at the same time, you're also paying tax on the other property. But if you don't have another property, that's a different story. Now, what if you move into your cottage as a principal residence? What's the tax implication? Well, if you move into your cottage as your principal residence later on to retire, then the portion that you did not assign primary residence exemption to your cottage, you would then have to pay tax on that duration. Let's use an example to explain. Let's say you own your cottage for 10 years, and for the first 8 years, you are sometimes occasionally renting it out, but you are using it primarily for yourself. And the last 2 years, you decided, hey, it's COVID year, I quit my job, or I have to just work from home all the time. So I decided to sell my Toronto property, and then I moved to my cottage for 2 years. Now, let's say you sell it at the end of the 2 years. Now you own the property for 10 years, the cottage for 10 years. The first 8 years, you had assigned a different property, the Toronto property, as your primary residence. So the first 8 years of capital gain on the cottage, you would have to pay tax on. The last 2 years, when you live in the property, you do not need to pay capital gain tax on. This is how it works if you are moving into your cottage and using it as your primary residence. So now that we cover the tax implication on capital gain tax, for those of you who are not intending at all to use your cottage as your primary residence, you can just watch this video there, and you would be able to see that how capital gain tax is being calculated and some other ways to lower your capital gain tax altogether. So make sure you visit our other videos to understand how capital gain tax works. And it works the same way for whether you own it personally or in the corporation. Now, the second tax implication is the income tax on your rental income. Now, let's use an example to explain. Let's say you rent out your cottage for $4,000 a week. It's not uncommon that people rent out their cottage for $4,000 a week, and you only rent it out for 4 weeks of the year. Let's just assume that's the case. So you earn rental income of $16,000. You only rented it out for 4 weeks of the year. So basically on your personal tax return, or in your particular situation, on your personal tax return, you report that $16,000 of income. You minus the expenses. The expenses that are eligible for deduction are similar to all the other expenses that would be eligible for deduction. For rental property deduction, you can watch the other video that we have here up top. the top 10 tax deduction for rental property. So you need to keep the receipt for mortgage interest, insurance, advertising, repairs, property taxes, or your Airbnb platform fee, whatever it is. All the expenses are eligible for deduction, but it is being prorated because you've only rented out your property for 4 weeks. So then the rest of the year, meaning the 48 weeks that you use it for yourself, you didn't rent it out. So that means for the tax return, for tax filing purpose, you're only eligible to claim 4 weeks worth of expenses. So we'll have to take all these expenses that are eligible for deduction and then claim only 4 weeks out of 52 weeks. So only a portion of it is tax deductible and the other portion is not tax deductible. We take your gross rental income, the $16,000 in our example, minus all the expenses, and then the net rental income would be subject to tax. Now, generally speaking, you try not to claim capital cost allowance, especially if you own it personally. The reason is because in the future, you might try to move into the property, and that may affect your deemed disposition and change in use, and it opens up a whole can of worms. So generally speaking, we try not to claim capital cost allowance to avoid future issues. The third tax implication is short-term rental. A lot of us are getting into short-term rental. Many clients come to us because we know Airbnb taxes. We actually have another video just specifically talking about Airbnb taxes. You can visit it on this particular link there. Now, short-term rental tax implication, when it comes down to cottage, it can get quite messy. For anyone who is renting out their cottage on short-term rental, including Airbnb, VRBO, cottages in Canada, Facebook Marketplace, you're renting it out for short-term for less than 30 days, you are considered conducting commercial activities. And what it means is that you need to charge HST if you are renting out your cottage for short-term rental. There is an exception though. The exception is that if your income from all of your commercial activities is less than $30,000. So what does that really mean? Well, it means that if you have multiple short-term rental in your personal name, say you have like 5 different short-term rentals, 5 cottages, and you're earning about $40,000-$50,000 on each of the properties, then that means you would not be qualified to claim this small business exemption, small supply exemption on HST. Because you have 5 properties, each of them are earning over $30,000 or just under $30,000. Say 30,000 times 5, you're making $150,000 short-term rental income. And so you are clearly over that $30,000 small supply rule. So this $30,000 small supply rule is not based on a particular property. It is based on you, the person owning it. So if you have a corporation, if you were to own the cottage in the corporation and your corporation is already registered for HST for other businesses purpose, then you automatically need to charge HST on the short-term rental income that you are receiving. If you are HST registrant, such as a realtor or self-employed business in your personal name, same thing. You have to charge HST on short-term rental at your cottage regardless, because you're already registered for HST. There's only one exemption, whether it is being applied to your business or being applied to your short-term rental, there's only one exemption in total. Generally speaking, from the sale of your cottage is not subject to HST unless all 3 conditions are met. Okay, there are 3 conditions. If you are operating and using it as a hotel or lodging house, so for example, some of my clients purchase a unit at Dehurst Resort, and some people who purchase this unit, their condo unit, they can place it in the rental pool, and the hotel operation would use it and place it in the rental pool, and people who visit the Dehurst Resort would then be able to use your condo unit for their own purpose. It's being rented out as a hotel room, essentially. So if you are owning one of these type of cottage style condo and being placed in the hotel pool, being managed by a third party and being rented out as a hotel, then unfortunately the sale of the property, the sale of your cottage would be considered subject to HST. Number 2 criteria, cottage is not used primarily for more than 50%. as a place of residence of the individual, a related individual, or a former spouse. So what it means, I know I spoke some tax term here, but if the cottage is not primarily used by you or more than 50% as a place of residence, then you might have exposure on HST. Lastly, all or substantially all of the leases are for less than 60 days. So if you are operating short-term rental on your cottage for the full year, chances are you might be dinged on this criteria. You might have to charge HST on the sale of your cottage. Again, it gets complicated, I get it. So make sure that you speak with someone who understands your particular situation and understand what you're trying to do, and see if there is a way out of charging HST on the sale of cottage, because chances are there are no one else, no buyers out there that would want to pay extra HST unless they are also using your cottage as short-term rental for short-term rental purpose. Now, we have covered a lot. We've covered the tax implication on capital gain, selling your cottage. We covered the tax implication on renting out your cottage long-term. We also cover the HST implication on short-term rental. And we also cover the structure on how you can earn. We've also covered the structure on how you can own your cottage. I hope you find the video useful. If you find it useful and you know someone is going to purchase a cottage, make sure you share this video with them. Or if you've already bought a cottage and you have some questions, make sure you leave the questions in the comment section below and I'll get back to you. If you like this video and find it useful, make sure that you give us a thumbs up and hit the subscribe button below. Until next time, thanks for watching.